Hello and welcome to another Wealth of Advice market update on the 28th of September 2021. Although the last update was only 3 weeks ago, it feels like so much has happened. So hopefully there's a lot to get our teeth into on this update and keep you up to speed with what's going on in the world of your pensions and investments. It has been a volatile time over the last few weeks. There was one day early September where markets all over the world fell quite sharply. Fears of inflation coming back, and I think it was the biggest one-day fall that we'd seen since July 2020. But since then, markets have recovered. The UK FTSE 100, for instance, is hovering around the 7,000 figure. Sterling has weakened slightly over the last few weeks as there's fears about UK economic data and what the future holds for us. But the picture's not all doom and gloom. Yes, there might be people queuing around the block to get petrol and such like, all on the back of some news stories that are causing people to go out and panic buy, which is absolutely crazy when you think that there is no shortage of the stuff in reality. But we need to understand how that might affect markets, what might spook them, and what the rest of the year looks like. In China, there was a big news story in the last couple of weeks regarding a huge problem emerging with a property portfolio owned by a big company called Evergrande, and how that was going to be saved, and if it wasn't saved, would that cause shockwaves to the markets in Asia, as well as all the usual stories that we've been having in the US. So definitely a period as we come towards the end of the year of more volatility ahead. So a lot of that volatility is arising as a result of fear. I mentioned inflation, but it's what's going on with energy prices, gas prices in particular, how the gas prices absolutely soared up. And if you look at this graph that we're putting on the screen now, you can see how quickly that's risen over the last few weeks. That's going to result in higher fuel costs for people domestically paying their electricity and gas bills in this country. But we've got a big problem in this country as to where we get our energy from, and that might result in higher prices for the consumer and big uncertainty for the markets ahead over the next few weeks and months. So this will definitely cause volatility in the UK markets. I was reading yesterday in one of the Sunday papers that the UK government has got 5 or 6 huge problems going on right now. The energy prices, what's going on with petrol, and we need to see how the government is going to come out of that. Inflation has been touted as the big problem. Yes, inflation is going to be high this year because it's based over a 12-month period and where prices were last year. So it's rising on the fact that prices were down last year. So we need to understand from the inflation figures what's just that natural bounce back from last year's prices being low, or what is inflation that's in there that's going to continue to rise. The energy costs and the energy prices is definitely going to be a big driver for that. Also in the UK, positive news from the UK. Early September we saw the biggest amount of people using the London Underground network since the pre-pandemic. That shows that people are getting back to work. The amount of job vacancies that's available in the UK, that's spiked. This could be seen as a positive or a negative depending on how you look at it, but there is around about 1 million unfulfilled job vacancies in the UK. Why that can be a negative is because if we can't get those jobs filled, then you're going to see supply chain issues like what you're seeing with the HGV drivers being a shortage of those. I was reading in the paper on Friday that fruit pickers are in high demand. We can't get people to pick fruit and vegetables, and there was a place, apparently the Daily Mail was quoting that they were paying £30 an hour for people to come and pick vegetables because there's just a shortage of people to do those roles. So that could be a problem in the long term if we can't get those roles filled. The government last night announced, over the weekend announces that they're going to change the visa rules to allow more HGV drivers to come into the UK from the continent. We need to see whether that's going to work and what difference that will actually make. In global news, you may have seen stories emerging over the last week to 10 days of a company called Evergrande. Evergrande is China's second largest property developer and makes up of all of 10% of the Chinese property transactions, which is absolutely huge. If you've heard the news stories over the last 10, 15, 20 years in China, the rate of property development over there has been absolutely vast. And for this company to make up, as I say, 10% of all those property transactions, it's quite worrying when you hear that they have over £300 billion worth of debt and they're struggling to meet their loan interest payments. Last week, they announced that they've agreed a debt restructuring deal, which pacified the markets. Now, we did have 1 or 2 clients who were getting in touch with us concerned about this. How might this affect the rest of the world? How might it affect markets if this big financial institution would go bust? Probably people thinking back to like what happened in the financial crisis of 2007. Northern Rock in our country was the first company name that you heard getting into difficulty. Then it seemed after that it was like a deck of cards that collapsed. So we spoke with Janus Henderson about this on Wednesday. Janus Henderson are a firm who we use to invest in government bonds and corporate bonds through the Janus Henderson Strategic Bond Fund. Probably around about half of our clients will have this fund in their portfolio, but their bond fund managers are what we would call experts in this particular area, and we asked their views on it and how Evergrande going bust might affect the global economy. And their response to us, this isn't new news to them. They've known about it for a number of years. They've known about this shadow economy in China and how there may be some issues with the amount of debt that was built up there, and they've not gone anywhere near it. She just said to us, the lady we were speaking to, was why would we need to touch that when there's so many other bonds in issue in the rest of the world. So there may be some high risk funds that might have exposure to this, but they were quite confident saying that their bond fund didn't have exposure, and if it were to go pop, it shouldn't have that big of a wide impact on global bond markets. So that was reassuring, and as a result we don't think we need to make any changes to our portfolios at this time. So we now come to that section of the update where we talk about how the various market indices around the world have performed over the last 1, 3 and 5 years. Hopefully you'll see that markets are doing well, and if you do look at the graph, the first one that's on your screen now shows market performance over 1 year. You can see that there's volatility there, but the markets have all spiked back up in the last few weeks, and the FTSE 100 for instance is up 25.99%, beating the S&P, which is the American index, only just, and also the MSCI World Index is just up 24% over the last 12 months. So it's very positive that the UK market rebounded well at the end of 2020 and has continued to perform well now. So that was the market performance over 12 months. We now look at the next, which is over 3 years. And where the FTSE 100 on the last one was clearly doing very well and was the better performer. Well, if you then take that over 3 years, you can say that the FTSE 100 has only returned 6.18% over that period. So many people are still saying that the FTSE 100 is a cheap stock market to invest in when you compare it to the fact that the S&P over the same period is up 49.6%. Obviously, it's not as easy just to say that you need to lift up the bonnet and look at what's on the FTSE 100, what type of companies are there, what type of market conditions are they going to do well in, compared to the American market there, which, as I say, is up almost 50% in 3 years, which is dominated by the big, massive global technology companies. And the final graph we show with regards to the market indices is how things have performed over the last 5 years. If you look at this graph, you'll see that the FTSE 100 is up 24.69% over that period, which is not such a bad return over 5 years. But however, when you compare that, the US market, which is up over 100% on the same period, you can clearly see the difference between having a stock market that's dominated by the world's dominant global technology companies compared to the type of companies that the FTSE 100 have on there. Brexit has obviously been a big thing for the UK market over that period of time when no one wanted to invest in our stock market as much because the uncertainty is what Brexit would bring. And now that we're out of Brexit, on the other side, with regards to a deal being done almost 12 months ago, and what's happening since, it still probably is that period where people are a little bit apprehensive about coming back into our market. But as we said, all our clients all the time, it's about investing for the long term. It's about having good assets spread across all the major markets around the world. And we think, as I said, that our portfolios are invested in the right places right now. The next graph that we show is obviously those clients who are invested in the Wealth of Advice model portfolios have looked at this quite closely over the last 18 months, coming almost 2 years now. But what we look at here is our £100,000 invested mid-February, 18th of February 2020. Just as the news of the pandemic was about to strike, markets collapsed. But anyone who had £100,000 invested on that day and has remained invested all the way through, hasn't taken any withdrawals out. That's an important thing to quantify here. That 100,000, if you're invested in our risk score 2 portfolio, which is roughly 40% in the stock market, 60% in bonds, is up to over 111,000. And those clients in risk score 3, which is roughly 60% in the stock market, 40% in the bonds, you're looking at £114,514 there. So over that period of time, a 14% return is absolutely fantastic. And we, as I say, confident that markets will hold up in the short to medium term, albeit there is volatile news stories that are coming all the time. The risk of inflation, the risk of what's going on in China, as I say, these news stories come out there. They're always going to be there. but it's all about staying in the market and understanding that you're invested in the right places. And just to finish off with the graphs that we're going to show you this week, we're looking at the VIX index again, the volatility index, which I know clients who have watched this many times over the last 18 months will have seen this graph previously. This graph shows where they believe risk is in the world, and if it really spikes up, you can see as it did back in February, March 2020 when COVID was really coming on top. You look at the index now and it's just at normal regular levels. So despite the news of Evergrande's debt burden and rising gas prices, markets have remained relatively stable. So this is certainly something we keep our eyes on, and if we think anything needs to change, we'd definitely be in touch. So thanks for listening to another Wealth of Advice update. As we always say, if you've got any questions, queries on anything we've said today, please don't hesitate to get in touch.
This material is provided for general information available from sources generally available to the public and is not a personal recommendation. As always, past performance is no guide for future returns. The value of your investments can go down as well as up, so you could get back less than you invest.